Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, May 28th, 2026. It is 12 p.m. Eastern Times. I'm starting the video, so we're about halfway through the trading day, and here's what I'm going to do in this one. I'm going to start out, as I often do, with an update on the equity markets, and I'll include the semis in there quickly. Been hyper focused on that. That seems the hot pocket in the market right now. And then I'm going to go over all the other stuff. I'm going to continue to do what I do. It's harp on the benefits of diversification and asset allocation. The reason I state that, you can deduce from the comments. I've been running this site for a long time. Started building it back, and I think it was 2011. Launched it in beginning of 2012. So we're over a decade into this, and the vast majority of the comments and the trades, the feedback on trades are on the hot stuff du jour, whether it's gold mining stocks if they're on fire, or Bitcoin when it's moving, or the markets right now. Semis seem to be the hot pocket, and I'll always provide frequent updates on the markets. But just wanted to state that trading and investing, trading just as much as investing. It's a marathon, not a sprint. And the same premises that apply to successful investing apply equally as well to swing trading, in my opinion. And what that is, it's spread your bets. Spreading your bets doesn't necessarily mean you have 10 or 12 positions. If they're all semiconductors or tech related, or you have QQQ or SOXX and NVIDIA and Alphabet, you have zero diversification. These things move together. So well-diversified portfolio consists of both asset allocation, which is different asset classes, stocks being one of those, bonds or fixed income being another, commodities being another, crypto I kind of put in its own category now. And then even within there, especially I think at this point in time, we'll see it's been a stock picker's market. Certain sectors are going up, many are going down. Same with individual stocks. So within stocks, the trade ideas that you're always going to have on this site at just about any point in time, I'm going to have a mix of both long and short trade ideas on the equities via sector ETFs and or individual stocks. You're going to have the same thing within commodities. Commodities are a lot like the stock market or the equity class of asset class, meaning there's tremendous variation and diversity. Crude oil has nothing to do with wheat, which has nothing to do with gold, which has nothing to do with crude oil. Sometimes, I mean, there may be a dollar sensitive component to those last two, but you get my point. So at any given time, there's a bear market in one commodity or several commodities, in bull markets and others. So that is, again, how we drill down. So just want to make that clear. And so spread your bets. Make sure you're properly diversified. Pay attention. I'd always do my best to tell you what trades might be an overlap to other trade ideas that I've shared. Whether it's a very obvious correlation, let's say you're long SOXX or short SOXX, and that's a semiconductor ETF. And then you also have positions in NVIDIA and AMD, ASML, Intel. You have zero diversification. The birds of a feather flock together. The sector is going to move up. Same thing with the gold mining stocks. Very high correlation. They all tend to ebb and flow together. Okay, so enough on that. I'm going to get to the equity markets and start out with a couple indicators. After I cover the main stock indexes, we're going to look at briefly the semis. I'm going to look at the S&P 500. Just a quick overview of kind of market breadth, showing you what I've been talking about for a while. It's a very, very unusual situation going on in the markets right now where only one, I repeat, and I've been saying this now for weeks, if not months, only one out of the 11 total sectors in the S&P 500 are trading at new highs and have been for a while now, and that is tech. No surprise. And semis are subsector of tech. So tech is also the biggest component of the S&P 500, so it's no surprise the market's up. But we're going to lift the hood up and look under the hood, and I'll comment on that. So before I get going here, I just wanted to reiterate, I've been at my convenient, or at my, when I can, following up on a lot of the videos with AI summaries. It takes a little while for the transcript to be generated. YouTube will first process the video. It can take up to an hour or more to generate a transcript. The first draft is usually rough. I'll have to go in there. There's a lot of typos. For example, if I talk about a ticker symbol, let's say, CAR for Avis, the ticker symbol, it'll put that as a car, C lowercase. And so I have to go in and make some edits to those. And then once I do, I try to do this within the first couple hours. I just wanted to say that, especially if you're not in a rush to watch the video, you can watch a video. You can come back later, look at the AI summary. They have timestamps often. I'll run them through different AI engines, and kind of show you, a quick takeaway. In 30 seconds, you can read what I've covered, where it's at. So if you can give two flips about packaged food companies, then you can jump forward to the timber and forestry ETFs and the individual stocks that I covered in there. Keep in mind, this is not all inclusive. Some of the things get mixed. So if you're really interested in the sector, individual trade ideas, you can go to that point of the video and watch it. And remember, you're not going to get these AI summaries in the email. That comes out the second I publish the post, so you can watch the video right away. And then, again, if you're interested, just come back into the site later. And I'll do this in many instances, not all. Again, time permitting, things are slow. I have time to do this. So, all righty, let's dive into the charts. We're going to start out with a breadth indicator. Yesterday, I started out with a sentiment indicator. Sentiment, of course, is how people feel. And the stock market, as we all know, or those of you who've studied it, sometimes has stark disconnects with reality, with fundamentals, with what things should be selling at. At the end of every bear market, price stocks are dirt cheap based on forward-looking earnings estimates and P ratios, all that, because there's mass bearishness and people are selling illogically. Same thing at the end of a big run, or especially at the end of a bull market. So this is one of many breadth indicators I use, but a very accurate one. It has a lot of predictive value. This is the, as you see in the upper left-hand corner here, the NAA 200R. That's the NASDAQ percent of stocks trading above its 200-day moving average. So that's what the line up top here you're looking at. I'm sorry, my bad. This is the NASDAQ composite up here. And this is just the tail end. This indicator only populates back to 2002. So that was a nearly roughly 80% drop, bear market in the NASDAQ with the dot-com bubble that followed. But again, the indicator only picks up here, so that's when I went back 25 years on this chart. And there's two ways that I use this indicator. Number one, just like a lot of the the charts I analyze using momentum indicators such as the PPO, MACD, RSI, and some others, I look for divergences. So in a healthy market, you won't have divergences, but towards the end of a bull run, whether it's an entire bull market like this was from here, we had a bull market from 2002 up to October 2007. Then came the financial crisis, about a 55% drop in both the S&P and the NASDAQ 100. And that was well telegraphed in advance by divergence on this indicator. So down below, the bottom indicator here is the percent of stocks in the NASDAQ trading above their 200-day moving averages. And so that's going to be a bounded indicator. Up top, you can never have more than 100% of stocks trading above it, right? Or nor can you ever have anything less than zero. So you can see on the scaling here, you have about 5% and then 82 at the high. We never made it to either of those extremes. That's just where they adjusted the scaling. So right here in the midpoint, I put a line at the 50 level. What that means at that point in time, if this line down below is at 50, half of the stocks in the NASDAQ are trading above their 200-day moving average, and half the stocks are trading below it, right? And so this is an unprecedented period. I've been trading. My former career as a stockbroker, 15-year career stockbroker since the mid 90s. Then falling in love with technical analysis and trading for my own account, leaving that industry to trade for my own account since. I've never seen, nor has there been, such a persistent and consistent period, this red box here, where we haven't had at least half the stocks, at least for any meaningful period of time. There was a couple brief pops. I'm talking just, go with me here. You can see the level. So it's been since really 2021, so right after the big COVID ramp up, we fell back below there, and that's it. So this is uncharted territory. And just like I'll touch on the put to call ratio index in a second that I did yesterday, just like those sentiment indicators, and something else I'm about to show you with the sectors in the S&P 500 that I've talked about. These are conditions, and I'm going to use analogies. I like analogies. They are conditions that they don't guarantee anything, but they point to something very likely. The analogy I'm going to use is, let's say you have that cough, nagging cough that's been persisting for months on end. And it's getting worse. And all of a sudden you start to have some chest pain, right? In your lower back or mid back as well. A week later, you start coughing up blood. Well, and let's say you were a smoker in the past. That may point to lung cancer, right? There's something's going on there, especially if the cough is getting worse, won't go away. It's not responding to any type of medications. And you have pain now in your rib cage, and you're now coughing up blood. You can ignore that as long as you want, but if it is lung cancer, the longer you ignore it, the worse it's going to be. And that's how the stock market is. That's why the crash in 2000 was so bad. The prices kept going up to unreasonable levels. And again, I don't have that chart in front of me. I encourage you to pull the Shiller P ratio, where at levels only seen since before the crash of 1929 and the crash of 87 Black Monday, and I think even well above the financial crisis, and just a few periods. So that's one of the best measures of valuation of the market. But so again, guys, these are conditions. They don't guarantee everything. So if you had all those conditions, the cough, the back pain, blood, starting to cough up blood, does it guarantee you have lung cancer or any type? No, it doesn't guarantee it. It could be something else. But the longer those conditions persist, the worse the outcome will be if ignored. And so that's all I'm talking about here. So I've been doing this, singing this, harping on the warning, the henny penny, the sky is going to fall kind of thing for a long time. And it doesn't matter, because we're going to get back into spreading bets, not seeing this chart and saying, oh my God, Randy's right, this thing's going to end poorly, and then putting all your money in on short the NASDAQ 100 or the semiconductors. There will be sell signals. We'll still have some pending, and I'm going to get to those in 1 second, and that'll be our timing. So these are conditions. The timing then is where we'll act. And until then, and especially even in after, any trade, even if you want to press a short on the semis hard or a short on the NASDAQ or the VIX or whatever your poison du jour is, that should never be all of your portfolio. If it is, you're a very aggressive trader, good luck to you. It may pay off well, but it may burn you. All right, so that's it, guys. Here it is. We're at 43.51%. So meaning only 43% of the stocks in the NASDAQ are trading above their 200-day, which means that well over half are trading below it, and that's been. Okay, so that's the absolute level I look at. The other thing are divergences, like I said. Just like we had divergence leading up into the 55% bear market there, then you can see we had divergence. They're all marked. I'm just going to read them out to you. These all follow divergent highs on this indicator, where we spiked up, had a high number of stocks trading above their 200. The market kept going up, but then you had a lower high. That's negative divergence, with prices making higher high and the indicator making lower high. 20%, 21, 11, I'm rounding off, 19, 25, 20, 30, 35 and 24% right there. And you can see this divergence continues to build. It's the same divergence right now that's been building from this point. So you get a few shots across the bow. And again, I'm going to reiterate like I did yesterday with the put to call ratio. It's the farthest thing in the world from an exact timing indicator. There's no timing element to this. It's a condition. The timing comes when you get the sell signals, but it does help to telegraph what may be ahead. In other words, you may get more than just a quick 5% pullback. All right, so let's move on. Just a quick recap because I covered them yesterday. Some of my favorite sentiment indicators are the CPCE, the equity only. I have a weekly variation where the line's up here, just it shows you what the weekly close is. And you have a cluster of persistently low readings without a reset. This is what I call a reset. When you have a correction, we had a bear market, you can see right there in 2022, about a 28% drop as measured in the S&P 500 after this cluster of persistently bullish readings. That's low put to call readings, extreme complacency, look for sell signals to close out longs and go short. We have a comparable, even bigger persistent low, and again, most important, without any reset. When you get a reset, it ramps up bearishness. Everybody starts buying a lot more puts and calls. You go to my buy zone up here, and again, so these are conditions, like I said, conditions that and again, technical analysis, like I just used the analogy, is a lot like medicine. There are no guarantees, but when you have enough clues, enough symptoms pointing to the same condition, that condition is very likely to be the culprit. All right, and so that's that one. Oh, in that indicator, I have a lot of little nuances here. I have a red line I added forever and a day. Typically, when you hit that line, you drop. It's a what is it? 100-period exponential moving, or simple 100-period moving average. And so when you get down there and you stayed there for a while, a top typically follows. That was a financial crisis, 57% drop. We kissed that level there. I like the 100-day moving averages because it smooths out these irregularities. You could get like when you get a big spike up, and like when we, started attacking Iran, you'll get a little spike up. So moving averages help to smooth out these regular EKG looking bumps. And again, you can see 21% correction followed that one. We hit it here. We had a sideways market for 15 months with 2 double-digit drops within there. We hit it right there. I'm sorry, right here, cross down below it. Again, a couple months lag. It can be a quarter or two, it could be anywhere from a few months, 6 months, sometimes 3 quarters. But ultimately that comes. And so we've crossed it here. And so far we're at new highs. So we're right about at that, not far from, if you look at the kind of the slope, if you will, or the angle of the lines, we're getting there. We're pretty stretched. And again, these are just measures of kind of extremes in the market. Okay, so this one is the daily put to call ratio right here. You can see same thing, equity only put to call ratio, but using daily lines. And you can see we've had that cluster of readings followed by that 20-something odd, 26, 28% bear market in the S&P back in 2022. And then since then, we've kissed my line. I have a little dash line right above that's really done the trick since about right here. It's about 0.4. You can't see it there. I try to zoom in for you. Let's do that. Zoom in a little bit. You can see it better in video land, especially if you're watching these on the phone. I always recommend look at them on the computer. So we kissed it there, and we've had 3 distinct, profitable to trade corrections. Even this one doesn't look like much because I have the S&P down here below. The S&P fell 10%. The Nasdaq 100 fell 13%, I believe it was, the beginning of the year there. And again, they were all very accurate. You hit this. Since then I had the red zone at about the 0.38 level, but I've noticed since this period here, about the 0.4 level does the trick. And again, boom, we top. Went about sideways for a month. We didn't go up any higher, and then came that big drop there. Again, we had it right there, big double-digit drop. And then right here, we kissed it 13% in the NASDAQ 100. And we just kissed it again, nothing yet. And this is also a cluster. So again, fear has left the building in the stock market right now. And most importantly, again, guys, I can't emphasize this enough. There's been no reset. After this bear market right here, there was a huge reset, tons of fear. We spiked up. That was everybody wanted to sell. That's when you wanted to buy. We also, even after this big correction here, we had a reset. We hit my buy zone. Again, these green, as it says here, the tags of the green line have provided some of the best long opportunities in recent years. We hit it right there, close enough right there, COVID. And so there's been nothing close to any fear since that last kiss right here on that little correction there. So again, guys, conditions that exist in the market. And I'm going to show you one more. Okay, I've talked about this in the past month or two, maybe going back 3 months on a couple instances. And again, it's unique. So I tried to use, in this case, Perplexity, which typically kick back better results than some of the other ones. Perplexity and Gemini are my go-to. There's others out there, but so I asked it to provide all instances where the S&P 500 was trading at an all-time high, while 10 of the 11 sectors hadn't traded at a new all-time high for at least 2 months. And so, unfortunately, it couldn't go in there. You have to upload a spreadsheet. It tells you there if I give it a spreadsheet and go through all this crap, which I don't have time to do. But it does state the last time. The clearest verified example is late January 2024, when the S&P 500 had returned to all-time highs, while only the information technology sector had done so. And the other 10 sectors were still materially below their prior peaks. Okay? Again, it's nothing I haven't covered, but we're going to go through it real quick. We'll just use SPY as the S&P. I have the same line here on the QQQ60. I'll get to that. This is that trend line we're waiting to break on the QQQ60 I gave you just earlier this week or late last week. The current trend line that needs to break. There was a breakdown back test there. Beautiful looking chart. I'm just have to mark it up because I follow usually the NASDAQ and the small caps, but those are the two I trade. But I do track the S&P. And we're right there. We're right on the line, guys. This is imminent. Like I said yesterday, I think if probably it was either yesterday or today. I think we get the break. I'm sorry. I'm going to get to the NASDAQ futures. We broke the trend line on the futures. We need to break S2 now. All right, so here we go. All right, S&P 500, all-time high, right? Clearly. Why is the S&P 500 an all-time high? Because although it is much more diversified, the NASDAQ is a great trading vehicle, but it's a tech fund, guys. That's all it is. They call it an index, but it doesn't have any financials. It's over 50% tech. It mirrors XLK, the tech sector ETF. It's chock full of semis and big tech, and it has a very flawed in the weighting, very high concentrations, a market cap weighted index like the S&P. In the S&P, because it's also market cap weighted, meaning the bigger the company's market cap, the bigger the weighting it has on the returns. It's also flawed in that aspect. But again, it is the market. If your 401k is in the S&P, then great. Who cares, Randy? That math's working for me. Yeah. But when it goes the other way, it has the same effect on the downside. So what I wanted to show you here is the 11 sectors. So there it is. We had that trading range, the whipsaw, the false breakdown, the recovery back above the 200s, which was bullish, very bullish. And then when we broke out above the previous highs, also bullish. So here's the S&P. You don't have to squint to see if it's trading at new highs. It's very clearly. And again, there's 11 sectors in the S&P 500. And I'm going to go through these in order of their weighting. I update this every so often. It doesn't change drastically. They'll tweak it from time to time, especially as companies are growing, but it holds pretty consistent. So this is the highest weighted sector. Remember, out of 11, this one makes up over a third of the returns of the S&P 500. Again, why? Because it's got chock full of the ones that are also the big $4 or $5 trillion club companies, right? NVIDIA, Apple, Microsoft. So in this tech, this is tech. Clearly at and again, you don't have to squint to see it. These were the previous highs. clearly at all-time highs. And remember, guys, what I'm going towards here are conditions. I'm lifting up under the hood. I'm the doctor that's putting the stethoscope to the market's back. I'm running blood work. Patient looks healthy. You look at them, they look great, but all of a sudden, man, their cholesterol's way out of whack. They got a high calcium score on the widowmaker artery, way out of range. This person's a walking heart attack. And that's what the market looks like. So there's tech. I'm going to rifle through the rest fast, get this video going here. This is financials, the second largest sector at, even though it's the second largest, it only comes in at about a 13 to 14% weighting right here. Last I checked, it was 13.68. So again, let me repeat that. It's about 1/3, even though it's the second largest sector, it only represents or accounts for 1/3 of the returns that the highest sector, tech, does. So tech dwarfs everything. And again, here's my takeaway. I'm just going to rifle through this. This is when we peaked. I put the line at the all-time highs. So this has now been, what is that, end of December, early January right there where the financials peaked. And they're nowhere close. In fact, they're struggling with their 200-day moving averages. Now, guys, as I say all this, keep in mind, just like that bad cough that you had, the pain in your back, maybe it clears up on its own. Maybe it was just a viral or bacterial infection, right? And it goes away on its own or with medicine. That can happen. And that's why I'll continue to pump out long trade ideas on the sectors and stocks that I'm comfortable with. And I see a lot of, there's a lot of long trade ideas on the site now. I have a lot personally, and I'm very comfortable with those. And that would be healthy. So just like that cough clearing up on its own, it would be healthy to see the rest of these sectors participate, even if tech corrects. So the short would be, I've got setups on the semis and trades on the semis, QQQ. You can correct there and see the rest of the market or some of these other key sectors start to pick up the slack. And that would help justify the stock market continuing to have a good year in 2026 and possibly beyond, right? So please understand this cuts both ways. I'm just telling you the current conditions, the current assessment. I'm diagnosing the market's internals by doing this. I already showed you one market breadth. Those are internals. That was the percentage of stocks below their 200-day averages in the NASDAQ. There's XLY, the financial second largest sector. Third largest is the consumer discretionary sector. That's XLY. Only comes in at about 11% weighting, but still, meaningful. And it also has some of the big, Amazon, even though it's kind of really a tech stock, they put it in this sector. And same with Tesla. I mean, it's hard not to call Tesla a tech stock. But again, it's in that sector. So I'm just trying to show you the composition here. Home Depot, TJ Maxx. But you look at the weighting, like last I checked on April 23rd, Amazon accounts for a whopping 27% of the return of this sector or this sector ETF there. And I use the spiders. Those are from the same company that the S&P 500 is. So that's that, guys. It peaked back here. Let me put my crosshairs up back in the beginning of January. And it still has yet to make a new high. So that's the third sector. We'll go through a little faster because I think my point's been made. This is the communication sector. Also has heavy weightings with Alphabet and Meta, even though, of course, those are tech stocks. But they kind of, for the purposes of the S&P 500, they're considered communication in that sector, with Disney, Comcast, Charter in there as well. So those two alone, just Alphabet, both the share classes combined, and Meta make up 30% or 1/3 of this. So again, it's a common theme here. And yet these sectors are still not at a new high. It peaked back here in the middle of 2025, and another peak there. That might have been the official high. I checked them all today, put them at 120.40, still below it. That's the fourth largest sector. Next one is healthcare. Not even close. I highlighted this as one of my top picks for alongside sectors recently with this bullish falling wedge and pullback to support. We broke out, continues to do well. This is another area where, we're starting to get, getting ready for the first correction, but it's nothing big. But I highlighted some individual stocks in there too. again, one of the better looking sectors, but way off its highs right here. Again, this one double topped in late 2025, early 2026. And again, I'm just showing you a common theme here. So that's the fifth largest. We get down to industrials. They come in at about an 8% weighting in the S&P 500. The industrials peaked also back in the beginning of January and still remain comfortably below that previous high in early January, or actually March right there. I'm sorry, that's where the high is, but still below it. XLP Staples, that also peaked earlier this year, well below it right there. Only a 5% weighting. Again, I've been sharing a lot of picks in this sector because when we do finally start to see tech and the semis correct, I have a pretty high degree of confidence you'll see some rotation into this sector from institutions. And like I said before, the charts, the ones we're buying are at or near support or just off it. They pay nice dividends, and so hey, it either works out or not. So put all your money in there, and just that's where making some small but steady gains lately. All right, the energy sector. This is now only as big as companies like ExxonMobil and Chevron are. This sector only makes up less than 3% of the S&P 500, but it is one of the 11 sectors, and it peaked even with gas oil prices going crazy. This one peaked back at the end of March right there, you can see, and remains well below its all-time high. And then last but not least is utilities. Again, this one peaked here at 47.80 right here where I put the yellow line, so back in March, and comfortably below it. So that's it. That's the story. I showed you the percentage of stocks trading above their or below, in that case, their 200-day moving averages. I showed you the 11 of the sectors. 10 of the 11 sectors are nowhere close to trading at all-time highs, with tech way above it. And again, the only time that I could get when has that happened before was right here. Make sure I follow up on that. When I gave you that perplexity, it said it was the end of 2024 right here. That's when the market topped, peaked there, and it was followed by the biggest drop in years, 22% in SPY, and the QQQ dropped about 26%. So virtually identical conditions as far as market breadth. So that's that. Okay, so yep, Randy, you've been making that case for a long time, but it just keeps going up. Well, it's going to go up till this is the trend line I gave you last week, I believe it was. I had to take Friday off to leave town. Then Monday was a holiday, and we've just been walking up. This is the current uptrend line in which to trigger a sell signal, and I gave you a BOD, or benefit of the doubt. So when I have two support levels in close proximity, you can wait for the latter of the two to break. And these are your targets. Still calling for a drop down here, but you got to get that sell signal. So until then, you just can't make a case for an aggressive short, although I did give you a sell signal there. This is just a marginal new high. These are the same targets. So if you're in it, again, your stop is going to be commensurate with your price target or targets. And remember what I've been saying. If you're new to the site, I have to recap a lot of this stuff. I know I get repetitive. If we come down here, what I'm calling for is a test of those previous highs there. T4 zone could take us down to about 636. Now, what does that do? If we go down to 636 here, it's going to take us down. Remember, the top of the zone. It's going to take us close. It's going to take us back for a back test of those the recent trading range. That's the trading range we broke out of right there. We had a false break. And then if we fall in the trading range, it increases the odds we're going to go down below through it, and we could lose the 200s again. So in other words, that's just all I can see right now. It's kind of like forecasting the weather. The weatherman, he's going to tell you, he or she, a good chance whether it's going to rain today, tomorrow, maybe even a few days out into the weekend. Trying to predict what the weather's going to be like 3 months from now is a lot harder than what it's predicting 3 hours or even 3 days from now. It's the same thing with technical analysis. So First things first, we don't have the sell signals, the latest ones, on QQQ, but we do on the NQ futures. Let me update you there real quick. We broke down, so gave you recently. This was our sell signal that we had to put us, on an active short right now on QQQ with the same targets. I have a total of 7 on the futures here. It's also going to take you down to the same level that that T4 and QQQ will. So these targets don't always align. Again, I have more micro levels. The futures trade around the clock, so there's more reaction points, and it's easier for me to identify support and resistance levels that do not exist on QQQ, because when you look at a chart of QQQ, it's trading from 9:30 to 4 p.m. Monday through Friday, where the futures are trading around the clock from Sunday evening till Friday evening, minus a 1-hour shutdown period there every day between 5 and 6 p.m. Eastern. So you have a lot more reaction points, and it's going to look a little different. So there it is. You did get the break of the minor trend line I was waiting for. That is a sell signal. But you hit S1. That's that benefit of the doubt support. Where do we bounce? Exactly on it. I didn't touch this chart since I gave it to you last. You can see, I guess I'll have to zoom in. And that's it. So we bounced right off that support level, and now we're currently back testing that trend line. But again, I'm a very multi-dimensional trader. You want to see, I didn't have the minor trend line on QQQ because it didn't exist. This is the trend line that needs a break on QQQ. IWM, I gave you that one as well recently. That one broke down just yesterday, breakdown, and it's still below the minor trend line there. So this one's on a sell signal. S1 was the trend line, so that's been broken. So I put a little check mark there. I don't have it on. Got to do a little. I forget there's a Windows shortcut thing to put a check mark on here. And S2, once that goes, it should increase the odds we go down here. So there's your update on the equity markets. I think I was very comprehensive on covering breadth, indicator conditions. Same thing like overbought when you look at. Let's just go to QQQ. Let's just look at a daily chart and turn on all the levels here. So you have on QQQ, we just hit the most extreme overbought reading that I can go back to when I roll back here, since right here, this was the last time we hit such an extreme overbought reading. And just like then, here, if you can follow me down below, I'm going to squeeze my indicators up. What often happens, not always, sometimes overbought is a one and done thing and then you correct, but quite often you have a second lower low, and that's what you had here. So you get the little divergence right there, negative divergence, and then that was a double-digit drop that took us back to the 200s. And that's exactly the setup we have now. It's right about to where I think we're going to go. Once you can see we have the divergence forming now on the daily. We have lower lows as the Qs have made a new high. It's that same trend line on the 60-minute chart with that little minor. Actually, the minor, I have it like this. I think I have it drawn like this, so we'll just do that. Okay, so that is this, what I've been giving you on the 60 right there, all right? Same thing. Okay, and so that's one that needs a break. And again, you can run this back as far as you want. I have multiple charting platforms. I don't have them all queued up, but you can run on some of them. I can go back 30 years and you'll see in very, very few instances have you become this overbought on the RSI. And then when you did, if you went higher, it's that second kind of lower low that usually does the trick. But the sell signal has to come. That's the break of the trend line. Okay, let's move forward. I made a very, very clear my thoughts about conditions and then the sell signals needed. The SOXX, this is SOXX semiconductor ETF. I got a lot of questions. I had somebody asked me to continue to update this. Absolutely, I'll watch on a daily break. We had a little whipsaw there. Then we had a clear breakdown. I gave you the first support level was that trend line, and then I gave you 1, 2, 3. Why weren't they? Because I think that S3 needed to give way, and it didn't. We pretty much defended that, bounced. All we've done since breaking this purple trend line, made a marginal, meaning slightly new high, and extended the same. Here, let me just bring the lines across. the same divergences that have been building. Let me just pull this one from that same point. That's where it started right here on the RSI. You had a peak right there, a high. And so we have the divergence, which is equal or lower highs in the indicator if prices are making higher highs. There was a minor trend line. It broke. We're currently back testing. So I'll give this market, I'll give these semis some points here. Very resilient, but so far, that gives us again, the day will tell us if this is going to prove to be a whipsaw. Right now, we're back testing that minor trend line. But again, you want to up your odds, wait for QQQ to break. Again, that's why I use multiple. QQQ goes, and there's that benefit of the doubt right there, S2, about 722. And just set a price alert. You want to keep it real easy. You don't want to be the second mouse to get the cheese. Set a price alert under 722. I'm going to round that down. I already set an alert at 06. 722.06. I'm just changing my line to 722. Okay, so that's it, guys. That should do the trick there. Let's round it out with the other stuff. Okay, so the other stuff, in no particular order. I just jotted some of the things down that I've been highlighting for weeks and even months now. Till this is a easy one-size-fits-all to cover some of my favorite commodities in the agricultural subsector of the commodities arena, and that is corn, wheat, soybeans. Till recently put in, this is a divergent high. I've told you it needed to take this $19.04 level out. It made an equal high in price. You can see the equal highs. That's my and negative divergence. So we've had a little correction there. Obviously, you want to see it remain above this trend line, but I can tell you also, well, I'm still longer term bullish. This pullback to this trend line and or this 1767 offer an objective long entry, as would down to but not below 1742. I don't want to see it go below there. The components of till, it consists of 4 commodities in roughly equal weights: wheat, corn, sugar, and soybeans. We'll go through those real quick. Wheat, I'm not going to get into the weeds here because this video will go over an hour. I'm trying to prevent that. I've covered my long-term chart on wheat. I don't have it queued up, and have consistently and persistently made a very bullish case, a long-term bullish case, when wheat was bottoming here on the long-term. You know what? I got to get to it. I forget that I'm not repeating the same video to the same people every time. Sometimes new folks are coming into the site, so I'll just go here real quick and show you why I very much like wheat for the long term. And we're going to go to find wheat somewhere in here, 30-year weekly. Is that my main chart? Nope. I got one more down here somewhere. Primary right here. Okay, this guy right here. All right, so you're looking at 30 years of price history going back to the dot-com bubble, 2000 right there. And what you have is a primary uptrend line that is just very, very well defined. And we've bought wheat on this trend line before in the past. These are all typical trades that we've highlighted in the past. Wheat has, every so often she likes to go parabolic. And parabolic trends, like I often say, just don't end well. And that was the last parabolic trend there. And so it brought us back to that long-term uptrend line. So I've been highlighting pullbacks to this long-term 25-year uptrend line as bullish. And then I said we needed to take out the downtrend line, and we did, and so that's it. Wheat is let loose. I've given you a total of 3 price targets, and we're only about a little more than halfway up to my first long-term target here. Here, you probably can't see it here. I think the screen's cut off a little. Let's run. There it is. So about 7, whatever that is, a little north of 750, 950. These are wheat futures, by the way. I just showed you the wheat ETN chart for those who want to trade that. So still a lot of meat on the bone. And anywho, and I have the same thing for corn and soybeans. I'll just show you corn and soybeans here. Corn Same thing. Nothing goes straight up. Put in a divergent high, just like you did here. These are still longer term targets, but we've pulled back to uptrend line support. And, nothing goes up forever. You have divergences, you get corrections even in bull markets. And so I just wanted to reiterate that corn is also, I also see some decent price support here. Why'd I add that line? Well, I see right here support, support, resistance, resistance, resistance. We broke out, we back tested it. We've gone through it a couple times, but it's also some price support around 18. So yeah, objective reentry point for corn. Again, you can use till, it's one size fits all. No K1, by the way. If you're doing an IRA, you can use these guys, but they're going to kick out corn, wheat, and soy. SOYB are going to kick out K1s, so just keep that in mind. Whether you do your taxes or give it to your accountant, so he or she can curse you on those K1s. But either way, IRAs, you usually don't need to report them. It's you could talk to your accountant about that. Anywho, this is soybeans, and I've been highlighting these for well over a year now. We hit T1, we hit it again. Then we broke out. We hit my second, third target. We recently hit T4. We put in some divergence, so soybeans may want to take a breather, come back, and if they do, pullbacks to any of these support levels or offer objective entries. The most I want to see a pullback to keep the bullish case intact would be the uptrend line right there off the lows. So, by taking till, you have a shotgun approach. Now, remember, corn, wheat, and soybeans, particularly, those three big grains move in concert. Sugar kind of does its own thing. They're not related, but corn, wheat, soybeans are just grown the same environment. The temperate climates, you can grow corn and soybeans and wheat on the same farm. So they're often subject to the same crop conditions and things like that. Cane is the sugar ETF, but this looks like a bottoming play here, and that's in there as well. So again, guys, one of many, just a way to spread your bets, nothing exciting. Nothing like the semis that are going parabolic, but just ways to round it out. And then the other ones I'll just touch on lightly. I have XLP, consumer staples. Like I said, we've had the subsector, the consumer food stocks. Packaged food companies that I've highlighted as recent as yesterday, so I'm not going to go over that. KHC is now coming up to the second target. We have General Mills starting to break out. Hormel Foods just hit my now second target today. I highlighted all these starting back right around here. I think it was around April when they were here. So we're up, if you took that one, depending on where you took it, and then I followed up with the bullish falling wedge. If you took that breakout that happened a couple weeks ago, you're now up 17%. So I know there's some semis that have gone up that much since then, but overall SOXX I don't think has. So like I said, I'll stay on these. SMJ starting to get ready to crack there, and that's not one of my favorite. CPB, Campbell's wanting to pop that little trend line, take off, and that Elway Beyond Meat, told you it needs to pop 82. I just updated it yesterday. All right, guys, let me see what else there is here. Oh, yeah, and then just yesterday, and remember, this isn't all-inclusive. What I'm just talking about, bet spreading here, spreading the bets. Wood and cut and all the individual stocks. I just did a video yesterday. It's got an AI summary you can check out, like these guys as well. I like the things that not everybody's talking about. Everybody's talking about semis. There will be a crowded rush for the exits. And again, you have the levels. You have the levels which will trigger the next sell signals. And you want to see QQQ breakdown as well. I also covered the specialty finance companies. Oh, and the home builders recently, ITB, taking a breather now. So we've had plenty of longs, and that's what we're doing. We're kind of tactically positioning on both longs and shorts right now. And I'm going to wrap it up here. But that's the key takeaway is you can see the market just keeps going up. We need the next sell signals to come to trigger an objective short intra add-on on QQQ and SOXX. And until then, and even if that happens, there's no reason not to keep, that's where you might see those blue chip stocks continue. We can see, I think this year will be a year if the market holds up. Now, if the whole market craps out, everything gets sold. But and I can see that coming based on all the sentiment indicators I've showed you, the extremes and all that. So keep that in mind, that the baby will get thrown out with the bathwater, meaning defensive issue staples, they'll probably go down. They're just going to go down a hell of a lot less. We're not there yet. We're above the 200-day moving averages. We start to lose, fall back below the 200s on the indexes, then it might be time to get out of Dodge. Until then, I continue to personally run, and I can't give individual investment advice, but my suggestion generically would be to keep a diversified portfolio, spread your bets. Oh, last one, Mike asked me about it, strategy. And I said, no, nothing's changed in my outlook or targets. It's still an active short trade. Broke down from the wedge here, ran up the 200-day moving averages. I revised my stop up before we hit the previous one there because I still very much like this trade. And so far, it's dropped since the highs. It's dropped down 27%, which isn't much for strategy. We're back to this. Remember, we shorted it here. We hit my third and final target. After that, I turned around, ran it long, gave you a total of 3 targets, although I decided to pull it at T1 just to be safe, and we did. We sidestepped that give back that would have stopped most people out. Then I stayed on it, and we re-shorted it here, and you have now a total of 4 targets. And yeah, that T4 is a kind of a doomsday target, but I think we're seeing it. Now, I want to comment on this real quick. Mike asked about, what is that, MSTZ. And, you're going to have an effect where it's a 2-time short. It's up 77%. This is when you want to own them. But my reply to Mike on whether you want to have that, right now, I still like the non-leveraged, just a regular short on MSTR. Or if you can find a one-time inverse. The time to juice up and move to the leverage, in my opinion, is when... Here's my comments. It's under this post from yesterday when the home builders ITB hit that target. You can read it here, but the best time to use a leverage, and the only time really to use a leveraged ETF as a position, a swing trade, something you plan to hold for more than a day. If you're going to hold it weeks, days, especially months, is when you have a high degree of confidence that you're going to have what I refer to as a mostly unidirectional drop or rally. This is when the 3-time or 2-time, in this case MSTZ is a 2-time. Did a whole video on it and why I picked that one. There's 3 out there that are leveraged short, but that had the best performance in tracking. My reply to Mike was, if you wait for the sell signals on SOXX, the next sell signals, so the higher probability ones, the break of those trend lines, and then you can make a good case. God help Bitcoin, because Bitcoin has been trading as initially it was a alternative to the fiat currencies, right? That's what the Bitcoin had crypto people, and I had to buy in. It's hard to argue that the system's rigged. Central governments, including not just the Fed, the U.S., they just keep printing money, debasing their currency to pay off their debt. So, and then gold was sucking wind, remember, for a long time. So Bitcoin, they called it the new gold, blah, blah, blah. Everyone buys into this crap, hook, line, and sinker. Gold's been around forever, and I said that at the time. Anyways, they bought into that, but where the kiss of death was, in my opinion, is when Wall Street was salivating over it and lobbied to get the regulators to allow it. It is now it's now mainstream and it's regulated via the spot ETFs. Now I understand, guys. If you have a crypto wallet, you can still use the blockchain or whatever they call it and transfer and move money. But they're coming after that. You saw Iran wanted to get paid in Bitcoin to allow passage through the Strait of Hormuz. If you read up on, remember the Louvre got hit a couple years ago. millions and millions of dollars of priceless artwork taken. There was a private museum in Germany, I remember the last year, 6 months ago or so, if you read about that, some very famous pieces taken. I follow this stuff. As the late great Charlie Munger said, Bitcoin is the currency of drug dealers, cartel heads, human traffickers, and so where I'm going with that whole artwork thing, and I've read up on this, it's becoming very prevalent now. If you are a Russian oligarch or a cartel head or just some asshole that wants to, own the Mona Lisa or whatever, Cezanne or famous painting. All you have to do is put on the dark web now, name a big price, say you'll pay in crypto, so there's no trace of the transaction. That's why these big thefts are happening. And so it was only a matter of time, I think, before they're going to have to shut that down. And they're starting to finally, be able to, well, from what I hear, trace a lot of the, direct crypto wallet transfers and all that stuff. So, and so if you want to know why I have a doomsday, kind of targets on strategy, it's the vicious cycle that will happen when strategy, and they've already announced, Saylor said it on the last quarterly earnings, that they'll probably start selling Bitcoin. And he tried to spin it as a positive just to finance their new special dividend, whatever. Either way, it doesn't matter. Where I'm going with this on this long-winded rant, besides the fact this is the key technical level, T1. When it takes that out, when it hits, and if hits and takes out my first target, I think this is where the unwind will start, the vicious cycle, the psychological and monetary impact of strategy. Or remember, Sailor Forever was iron fists. Never sell, never sell, never sell Bitcoin was his motto. Now, well, yeah, we have to sell Bitcoin. And again, when they sell it, they hold so much that in itself is going to impact the price, and it's also going to be a psychological blow. Like I said, dimension and all the other things I've mentioned before. That now it is Wall Street's jumped into what used to be an unregulated asset class, and now they've got their hands all over it. And IRS, if you do your own tax returns, there's a little checkbox started a couple years ago. Have you made any transaction in Bitcoin or any cryptocurrencies that aren't being reported? And if you check no, that's tax evasion, tax fraud. So they're coming after it, guys, and that's all. So I think it's safe to say that crypto's over. I could be wrong, but guys, I don't trade on. I just spewed out a lot of long-term fundamental ramblings. I trade off the charts, and as you can go back, if you type in MSTR or the GBTC before the new spot Bitcoin ETFs come out, you'll see as many long trades on that we've had, successful long trades, as we've had short trades. I trade off the charts, but I do factor in the fundamentals. So if you're wondering why I think that strategy could drop 93%, which is almost a full loss on your money, or a big, huge profit if you're short. Again, I just explained it. I think it'll be a vicious cycle. It's incremental, but the odds start to go up exponentially once we take out T1, which is the last time where we covered our last short from right here, and we went long. We gained a bounce that initially I figured might go this far. Kind of called it there. Didn't do anything, waited patiently, and then started shorting it here recently. And yeah, that's where I think we're going. And again, the takeaway to answer Mike's question is it has been trading, as I've covered many times in the past. It used to be kind of an alternative to the stock market, and it even traded at times inversely. When the stock market went down, in the early stages, people were buying Bitcoin. And again, since Wall Street got a hold of it with Bitcoin futures and Ethereum futures and Bitcoin ETFs and all that other stuff, it's become a risk-on asset. Now, so where I'm going with this, so what's happening here with strategy and Bitcoin being down, 26%, with the NASDAQ making new all-time highs? God forbid the NASDAQ breaks and the semis break, and then we revert from a risk-on market, which we're very, very much in right now. Nothing's more risk-on than semis. They're a hot trade, and they go up big when they're going up, and when it goes the other way, it goes down. So you could see the bottom fall out of Bitcoin And then at that point, so my takeaway was, and my reply to Mike is, wait for the sell signals, those next sell signals I'm waiting for in QQQ and SPY. I covered SPY earlier. The more of the big indexes break, the higher the probability of those breakdowns will stick and not prove to be whipsaws. All right. So I'm going to end it here, just under the 1 hour mark. Remember, you can always hit the fast forward button, increase the speed on these videos, 1.5, 2 times, whatever you can listen to. And I also will post the AI summary with timestamps as soon as I get a chance. This has been Randy Finney with Right Side of the Chart. Have a great day.